I think we are heading into one of the worst recessions we have seen since the 1930s. Bitcoin will come to a massive top. And if it drops below, which I think it can, 10,000 easily, Bitcoin has never seen a real recession. You have something that is highly correlated to the stock market. And the stock market is now in a very big bubble. I claim it will drop more than 95% into the next crisis. The economy itself is slowing. There are so many indications. We're probably in that final dance now. It's getting close to 12 o'clock. The problem is the real economy at the bottom, 75% of the population is struggling. The water is coming in on the Titanic. The third class passengers are seeing the water coming in. Compared to 2008, it's not in the first line of the banks. It's in the private credit system. So in the shadow banking system, it's the perfect storm. That's why I call it the end game.
Archie.
Henrik Zeberg, the chief macroeconomist at Swissblock. Welcome, man. I got that out the second time around.
All good. Thank you very much for having me on.
Yeah, it's a pleasure. And I mean, I was really looking forward to having you come in for a chat. Like I said to you, I bumped into Willie in Lugano and he's been talking about you. And I said, well, I've got to get him on board. I'm always looking for new, interesting opinions. And having scanned through your timeline, you certainly have some very interesting takes and some, I guess, rather optimistic takes as well.
For now, yes.
For now. Yeah.
For now.
So where are we right now? So just to let people know, by the time we post this, it may be about about a week's time, Charles. Yeah. And so right now, as I speak, I've literally just posted a $91,000 Bitcoin update. What's going on, Henrik?
Well, I think you've seen a liquidity drain because of everything we've seen with the U.S. shutdown. You've seen that has actually pulled some money out of the system. I think there is nothing moves in a straight line, as I normally say. So you'll also see that you have these pullbacks. This was a bigger than I expected. I mean, I have to say that, but I'm still very, very optimistic on the coming month and a half, 2 months as a maximum. I don't think it's going to last much longer. I think we are at the end of what is a super cycle, you can call it. When I say super cycle here, I mean that we have had a number of years, a few decades actually, where this about printing money is something that has been seen as the new, grace from above in terms of how you manage finance, you manage the economy, and it's not. It's something that you will see that when you start to print money, you will. For a certain amount of time, you'll see that everything feels good and fine, and it'll seem like you can just get wealth, created out of thin air. The problem is you cannot. And if this was the case, you would probably have seen other central banks and other administrations over the duration of the last few decades, not just decades or centuries actually, moving into this kind of thing to make sure that you just have economic prosperity. The problem is you cannot have it, and there is nothing new under the sun here. This about printing money is something we have seen before. Go back in history, you can look into before the French Revolution and so on. There has been these incidents of trying to do something which is just should change the direction of the economy. By the end of the day, what it has done is that it has distorted a lot of capital, a lot of human capital also. A lot of, you try to suppress interest rates, and you could do that because you have had a long period of disinflation and outright deflation also sometimes, which have created an environment where you actually could print money. But the problem is there's an end to all of this. And the end comes the moment when you start to see inflation coming up. And guess what? We saw that after the COVID, or the COVID stimulus that came out from not just the US, but from around the world, central banks and administrations. So we are at the end of this experiment, which now has one more go. And in this experiment, which seems to have been going on for such a long time, so people hardly can understand and comprehend that is actually just part of the experiment, that since 2008, that was when it really started. And then you have had this in the final hubris of the central banks was in 2020 when they just, came in with, everything. So we are at a very, very big end, but it doesn't mean that it's rolling over tomorrow. The economy is not there where it rolls over just yet. And even if it was, we would still see that the market could do one final and strong push. And I think the next month and the 2 months here, because of the liquidity that is coming out, will help the market actually accelerate into a final blow off top. And I think it's going to be one hell of a ride in the next month to two.
Looking for a secure, trusted way to buy, sell, and hold Bitcoin? Gemini has been leading the way since 2014. Founded by the Winklevoss twins to be a security-first, fully regulated Bitcoin platform, with Gemini, your Bitcoin is protected with enterprise-grade security, backed by insurance and Type 2 certifications for both SOC 1 and SOC 2. Whether you're new to Bitcoin or a long-time hodler, Gemini gives you the tools to stack sats and build generational wealth your way. From simple one-tap buys to advanced charts and trading features, it's all here. Buy, sell, and hold securely. That's Gemini. Gemini. Bitcoin with confidence. The DeBiFi Prepaid Visa card is here. Just borrow against your Bitcoin, load US dollars onto your card, and pay instantly. No banks, no selling your Bitcoin. Just secure, short-term loans backed by your Bitcoin. Ready to spend with your DeBiFi Prepaid Visa card. It's also non-custodial. Your keys, your Bitcoin, always. Get cash, keep your Bitcoin upside, and spend it anywhere. That's DeBiFi. Bitcoin-backed loans, now in your wallet.
It's interesting to me that you mentioned 2008 because that was really the first time I became aware of, the government stimulus through printing money when the Obama administration famously printed an $800 billion stimulus package, or I guess you could say monetary debasement. And at that time, $800 billion seemed like a lot of money. And when I say that, I don't mean it. I don't mean to say that glibly. At the time, when the White House was asked, how did you come to the 800 billion figure? They were briefing the press that we wanted to pick a number so large that it would reinstill confidence in the markets, that they thought everything was going to be okay, and so people could then go about functioning normally in quotation marks, within the market, and they didn't have to worry about liquidity or stimulus or anything like that, that we were absolutely committed to getting the economy back on track. Fast forward now, almost 17 years, and we're talking trillions that are now required to keep things going. Famously, the 1971 graph, what the fuck happened in 1971, do we have to go that far back to trace the origins of this policy, or was it something else that was born in 2008?
Well, first of all, fantastic comparison to 1971, which is a good year, but there is a little difference, a little caveat to that. But if you look at what we saw in 2000 is exactly this what you're talking about here, that we had something which seemed extreme at that point, and now we're just talking about something that is even more extreme, just to make things going, right? And what is normal, what we're trying to do, first of all, the 800,000 that they came out with back then was simply just
800 billion, sorry.
Billions, right? Yeah. That was just to backstop the banks there back then. But if you look at all the stimulus that the central banks have been sending out afterwards, you've seen that the central bank's balance sheet back then was around 800 billion at that point. And then you have added on, I don't even remember how much it is at today, but we are talking about 5 or 6 or 7 trillion extra on top of that in terms of balance sheet. And the 900, 800 billion we were at that point was actually something we have been developed since 1913, where the central banks was, the Fed was established. So it's quite remarkable what happened back in 2008. And this is why also this is an experiment. This is something that they hope will work, that they at least they now, it's kind of, the judges have already spoken because they gave Bernanke the Nobel Prize for reinventing printing money. But the thing is, we haven't seen the final verdict of this. And we're beginning to see some of it in Japan, for instance, because what you do through QE is that you suppress rates. And when you have an investment, you look at as an investor, what can I get on a safe bet on government bonds? And what can this project actually deliver? If it could deliver 5% back in the days where the interest rate was 5%, you would say, well, why would I bother? Why not just keep it, with the government bonds? Because then there's no risk to it. The problem is when you want to stimulate the economy, you want to bring forward investments. And you want to trigger investments. People say, okay, we need to put money into this. And you do that by selling people, you cannot get this safe rate of 5% anymore. You can get 2%. which makes all people sit there with $1 million or more thinking, okay, where can I get, something that is higher than 2%? And then all of a sudden, all sorts of, fantastic projects comes up. And guess what? When you then lower to 0%, and especially also negative, I've seen in Europe, then everything can work, everything can go. I mean, if you have something that gives yields 0%, but promises something of a big upside down the road, you'll say, I get 0 on the treasury bonds, and I could get 0 here, but here I could potentially get a big upside. You know what? I'll try to go with that. And then that becomes a self-fulfilling prophecy. So you will have things that have no, in the real world, where there was what you can call somebody who actually, kept everything in check, which was the interest rate. If that is completely taken out of the equation, you're going to see valuations going to extremes. And that is what we see. That doesn't happen overnight. That doesn't happen overnight. And like the QE doesn't happen overnight. It happens gradually, more pushing down things. And now we are in 2020, when we then all of a sudden see also a shock to the economy from the virus and so on. But then they just went all in with that. So the problem is, at some point, interest rates will go up. Why? Because you get inflation. Because for as a long time, you start to do, and especially what they did, and I call this the inverted the inverted Volcker moment, when they go all in at a time where people have to go home and they start sending out stimulus checks, fiscal stimulus. That is extremely inflationary, and especially when people have to go home because they, can't meet up at work because of the virus. So all of a sudden you had demand up like this, and you had supply like this. What that did was that reintroduced inflation into the system, and that is what we've now been challenged by. Of course, when you put so much money, stimulus into the system, it's going to bring about a bounce. Of course, it will. But the problem is, its ugly sister just follow along, which is inflation. And that ugly sister is now taking the front scene here at this point here. They're trying to get inflation down. It's kind of sticky. I don't think it's so much of a problem on the short time frame. But I think if you look at the long-term charts, we have seen a significant shift. And there is an expectation of inflation in the population, which is worse. Which means that when the Fed tries to come out the next time, if I'm right on the bust of the AI, then people tell me, Henrik, you don't understand this because the Fed will not allow this. I'm saying, if they do that again into a system where inflation has already been kind of baked into your backbone, and you say inflation can occur. I mean, I'm 50 years old. I hardly can, remember inflation as being something. But, ask our parents or grandparents. They can tell you that we had inflation, right? And it's not like we have outlawed inflation or, got rid of it. It's there. It's just because we have had an inflationary regime because of the globalization and everything. Now we have shifted. We have turned that corner. That is why there is a completely different situation now. We have a large and a massive bubble because of the suppressed rates where valuations have skyrocketed, and we have reintroduced inflation to the system, which means that if they come out one more time, even when deflation is coming in, you will see inflation spiking up. And that's why I call it the end game.
I'm fascinated by that because you touched on the deflationary forces of globalization, essentially, manufacturing being outsourced to much cheaper locations, mostly to China.
Yeah.
And that should have yielded an efficiency dividend or a deflationary dividend to Western societies. But instead, what we've seen is an acceleration of money printing to fill that void rather than for us to yield lower prices. Now, when I look at what's happening to the structure of the economy now from a technological point of view, there is a huge expectation that AI will, be an even bigger deflationary factor compared to China and perhaps even at a faster rate. Mm-hmm. Only this time, I don't see where new jobs are going to come from. So why wouldn't that offset the upcoming anticipated money printing that we're talking about now? Very
good point. And I think you're right. I think, first of all, AI is going to be a deflationary factor to the system. But there are the inflation that can also come because of the expectation from the consumer. So there is some kind of downward pressure on inflation like with that. But what you typically see in the long-term perspective is that inflation goes up and down like this. So what I think you're going to see is that you will have an anticipation of the of higher inflation, and you're going to see that can be moving up also because of the vast quantities of money that has been printed. And if that starts to set in motion, and there's always this, that you have the quantity of money and you have the velocity of money. And what you've seen is that the velocity has been crashing. And you've seen the quantity that they have tried to, as you rightly said, you've been seeing that moving up quite strongly. So if we start to see that circulation and people start to expect that there will be a higher inflation because of money printing or whatever it's going to be, you can ask anybody, they'll say there is inflation in the system right now, right? If that is the case, and that is kind of gotten hold in the backbone of people, that will be what is driving things. Of course, the AI can help us, suppress some of that. But I'm just saying, I think the long-term trend is up now, and that's what you see in the chart as well. There is a lot, and Jeff Goundlag and the likes are also talking about that we now have a secular upswing in inflation, and I think they're right. I don't think short-term, because I think you're going to see a deflationary bust as the market will reach a top, and we're going to see this bubble exploding or popping. But I think you're going to see long-term that the expectations of inflation, and also in particular, also potentially driven by the situation that we'll try to describe here, where the Fed comes out one more time. If we see the pop of the bubble here, the Fed will come out, try to prevent it, obviously. What I think you're going to see is that, as I always refer to Mrs. Johnson in the US, or whatever, Mrs. In the UK, and Mrs. Jensen in Denmark will sit and look at that and say, well, I've seen price levels going up 20% since 2020. I've seen my house mortgage loan just simply soaring. And I've seen that I potentially can become unemployed as well, because I've seen, people getting unemployed if my bubble burst. If you don't spend that money that the Fed will come out and try to help you get through your mortgage loan, you will see that the QE will not be effective in the real economy. You might see that it will be effective in the financial market, and they may cheer. And you may see also that it can move into real commodities, which I think it will, which by itself can be spurring an inflationary cycle. So I think you're going to see that it's simply it's the psychological behavior of consumers that is going to help us get into that kind of environment.
You mentioned, you broke down the monetary aspect in two parts. One is the supply. What determines the supply of that? Is it merely the central bank? And second, what factors drive the velocity of money, and why is it falling right now?
So it's not just the central bank, as you said. It's the credit system, and the credit system is where we have the banks, which will look at you and say, okay, you put in $1,000, and then they'll lend that $1,000 out to 10 or 15 people, and they will say that your box is, your money is here in the bank, but they will just still lend it out to somebody else. So if everybody runs in and get their money, that's why you will always have a cash shortage in the bank. So that will drive it. So obviously the banks are the drivers of this credit cycle also. And that's why there needs to be a demand on the one side, and there needs to be a supply. That means that demand will have to come from the consumer saying, yes, I think it's great to take on a loan now because I feel good about my future. You'll never take on a loan. If you feel bad, you'll say, we will postpone this loan here because I'll postpone this kind of acquisition or buy or whatever of a new car or whatever it may be. So you need to have demand, and you and I need to have the supply. And that is where things have been where we will see potentially that the banks will now in the short time frame start to look at, we may have some risk. They don't see it right now. And I think that the situation we have at this time compared to 2008 is that it's not in the first line of the banks. It's in the private credit system, so in the shadow banking system, where we have the problem this time. Because everybody has been with $1 million on their bank account, or have been coming together and say, well, how can I get yield? Let's go to some private equity companies. Let's go to all sorts of adventurous kind of investments, and then saying, well, you can borrow the money from us. And that's what we see right now. That's why we start to see these auto lenders and whatever going belly up. I think that is the subprime in the next layer, in the private credit layer there, which we do not have an overview of. And that can become a problem because back in 2008, the backstopping of the banks, the 800 billion backstopping through the U.S. administration and the central banks and so on, kind of could backstop the banks that we have. The problem this time around could be that if we are in a situation where the consumer is now starting to see that we know that the consumer is in a depressed situation right now. We can look at the consumer sentiment. We can look at the consumer affordability. It's in the gutter. We can look at the existing housing sales is in the gutter. So if we look at all that, it's probably because the consumer is not too well feeling well. And so you're probably going to see that is going to hold everything back, and potentially you're going to see that will put downward pressure on the economy. That's what I see, and the downward pressure will also develop into something of a black swan, because if the consumer cannot pay their bills, they cannot pay their mortgage loans, and you can see that delinquency rates are now moving up, then somebody's going to get into trouble. And that could be the private credit layer that I'm talking about. So I think you have a private credit layer now that is that has troubles. And we don't know how big that is. And the dominoes now, this time around, could be lined up in lines, touching on the bigger ones, but it's in a dark room. We just don't know which ones. Like back in 2008, we could simply just look at the bank's balance sheets and say, okay, this bank and that bank. This time, it's much more opaque kind of a situation as I see it.
How is it that, so many years, almost 25, 28 years after long-term capital management, and then we had, the CDS drama in the 2008 financial crisis, we're still now at a point where there isn't any visibility and proper oversight of the shadow banking system, and it's allowed to persist at a scale many times the official regulated banking system. How is that allowed?
I have no idea. But I think they did what they needed to do back in 2008 and thought this is only about the greed in the banks. Now it's probably also going to be the greed just in everybody else with some money in the bank. And the situation is, we also have to understand that is actually the ugly downside of printing money, is that money will always seek yield and a yearly return. And if they cannot do, and if they can, what they can do, then they'll pop into all sorts of adventurous investments, or they will try to go, through other routes to find yields through some kind of consumer loan. Oh, you want to borrow some money for your car? Great. So you can't borrow it in a bank because of something? Great, you'll borrow it with us. I'm not saying that's 100% the system, but the situation, I think it might be, and I think we have a potential unfolding there. It'll be interesting to see when we get a little further down the road here, whether we are going to see some layoffs also coming now, which I could guess we may see in the US. And if we do, what does that then mean for the ability for consumers to actually, maintain their loans? And will that then mean that we'll see more downfalls of potential, private credit suppliers? And then you're going to see the banks all of a sudden going to suffer as well. I think that is the domino effect we're going to see.
Apologies if I didn't quite understand your explanation, but velocity of money. What determines velocity of money? Because, the way I think about it is that money's never really locked up. It's always somewhere, and someone's always got it trying to do something with it, right? And so, what determines the velocity of money? And why is it going down now? You said that velocity is falling while supply is increasing.
You can say that it's often it has to do also with the very definition of how it's actually being calculated. That's one thing. But the thing is that by the end of it, if the velocity of money is really also in the hands of the consumer, and if the consumer is starting to spend more because of if they get a fiscal stimulus check, that is one thing that will send velocity up, and that's what we can see also after the 2020 crash. Actually, you saw the velocity of money just to that point, and all of a sudden everybody was given a stimulus check. That actually raised the level of that. So you see that this is that is one of the drivers, or the driver, and the moment when that starts to speed up. Plus, you have the big amount of money that we have seen being printed over the years. That can create inflation. That can create a self-reinforcing effect, because if my prices that I'm seeing at the grocery store goes up, then I'll have to have more in wage pay and so on. So it's a triggering effect, and that's again the expectation of the consumer is very, very important. And if you look to the expectation of the consumers right now, they think that inflation is coming, and they can see it because it's been there now for such a long time. And if there's something that is sticky, and that's probably also why it's sticky, that is the expectation from people. If they see inflation has been higher, and they will also, some of them have a difficulty in understanding that there is a difference between inflation and price level, which means that you've seen inflation for a few years. Now it's not that high. I mean, 2.7 is not a problem. But if you've seen that the price level has risen from with 20%, that's a different matter. And that is what people are actually referring to very often. If that builds into the expectation of, how then people go to say, dear Mr. Employer, I need a little extra and I have to pay my wage, my mortgage loans and so on. So I think that is a trigger. It's very interesting to actually, because it's a psychological kind of circle. What is it that drives what in terms of, getting higher inflation? Why wouldn't we always just think that inflation can be pushed downwards? That's just not what we see. We can see it's cycling up and down as you're going to the cyclical nature of it over the long duration.
It does seem to me that there are two types of inflation, and one with a little bit more resistance to the other. And certainly for asset price inflation, everybody in society who owns assets, and from the political system to the economic system, seems to applaud any time there's asset price inflation, even when there's no additional utility, for example, in housing. And yet, consumer price inflation is obviously, as you just mentioned before, is something that's fed and accelerated by the velocity of money, distribution of money into the hands of people. And there seems to be so much more resistance to that, even when the intended effect of stimulating the economy is more effective that way than through asset price inflation. Why do you think... I know it's a rhetorical question. Why do you think we're seeing a greater willingness of the political and economic class to stoke up one type of inflation and not the other?
Because there has been this belief in this trickle-down economics that if you push levels up from that's the way, also QE or monetary policy, as it would be phrased back in the Keynes days. So you will see that if you can lower the interest levels, and people say, okay, then all of a sudden the valuation of whatever I have is a little higher, then I'll be more prone to go out and spend money. So that is the understanding that you see a wealth effect coming through the monetary easing, and that's what we've done. We just completely raped that, way of stimulating the economy, because we just gone, to extremes that are so crazy that, I don't know where we're, so that's what we don't like the other one, because that's more direct, and we don't like it because if you put money in the hands of people, they'll spend it. You can see people didn't save up a lot of the checks that were given back in Corona. The people went out and they spent them.
But isn't that what we want them to do when we give stimulus out there? Is that like the whole purpose? It's literally called stimulus checks, right? And you don't get the stimulus unless people spend.
No, correct. But then again, and that's the balance act you have to, to tread. You need to do that. You want them to spend the money, but you don't want the velocity of money to go up. And the problem is that is very deeply correlated with the expectations of people. So if people expect you're going to see inflation and you give them a stimulus check, they're going to see inflation. And also, if there is a supply restraint to things, then it's going to be even more inflationary. So I think you're correct. You want them to stimulate. You want to stimulate it, but we don't want the ugly sister coming along.
And it feels like, I think policymakers have perceived this as being some kind of free lunch while we've been living in a deflationary global trade environment, which, we're on the sort of cusp of that not falling apart. I think China and America are kind of feeling each other out and not really wanting to pull the string too far and unravel all of that. But they're kind of threatening to, right?
Yeah.
Without really making it happen. So I'm like, are they going to do the exact same thing when it comes to the deficiency dividend of AI? Are they going to have to do that? Because my perception is that, please correct me if I'm wrong, is that this whole thing for about 30 years has been a war of one generation upon all those that came after. And I'm, quite disparaging of baby boomers and the policies that they've enacted. Is that they didn't want to see their portfolios go down and take the hit of, malpolicy with respect to the economy, and they wanted to make, and the other thing was that, pensions and social security was not funded, so they tried to do that through asset price inflation as a result. They've locked out every subsequent generation from being able to buy a house, and as a result of that, start families as well. So I perceive it as kind of a war of a war waged by boomers onto every subsequent generation. Now, we are now at a stage where I think the efficiency dividend from AI is going to be markedly different, because I don't think there's going to be any countervailing jobs boom. I think a combination of AI and robotics is going to mean there really isn't going to be any kind of job that you're going to be able to seek refuge in.
Correct.
And so that's going to leave a large number of people who are going to be bereft of any opportunity to generate a living. And we're talking sort of at the macro scale. We're not talking about like individuals. You know, you could always advise an individual to be more entrepreneurial or work harder, hustle this way or that way. But at scale, that advice just doesn't scale. We're going to get mass unemployment, I think, or at least the way it looks right now.
Yeah, I agree. I completely agree with that. Yeah, sure. But I think and again, as you said, the imminent effect, or the effect alone, what do you call that? The single effect from AI by itself will be deflationary. But because it will take so many jobs away, and there will be people that are my age and above that still needs to be in the labor force to also produce things, and but more of all, actually having an income. I think that's where we can get to the next crazy thing here, which can be UBI, universal basic income. I mean, that we could get to the point where we are looking at all these robots who does everything for us, AI, and we are so productive, and we actually don't need the kind of human interaction to the same degree, and we'll have a huge amount of people being irrelevant to the market, to the labor market. What do you do about that? Do you just let them, we don't need you, we just let the labor market actually work with what we have? I mean, that is a very, very big problem. That's something we have pushed aside, and not, I remember 20 years ago when we talked about UBI and at the university, or 25 years ago. But it's something that is probably will be on the table at some point, saying we need people to be able to exist. They need to be able to buy food and pay their rents and whatever. And that could be the reason why we actually see this as a potential inflationary development also, because we actually will see that at some point there will be not just a stimulus check, but they'll be like, okay, we're going to make sure that you will have a basic income, and that will be very, very inflationary in the longer term perspective.
Which is why I raised the question of resistance to that kind of distribution. And I know, like, a lot of people get triggered by the word distribution, especially when it comes to economic policy, because it invokes sort of themes of socialism and communism. But we're now seeing like a number of conflicting forces. We've got economic ideology. Once it's superseded and you hold on to it, that becomes dogma. And by dogma, I mean it's no longer really has any productive value, and it can be actually detrimental to society. And on the other hand, we've got a massive technological wave about to dump on the shore, and its effects are going to force a complete rethinking. But I'm not sure, as a society in Western nations at the very least, and perhaps in the Anglosphere. I'm Australian and I live in London, and my observance of culture has been deeply influenced by American media, of course. So this is front and square in terms of what my focus is, and I'm like, I don't see the political discourse around economics as capable of dealing with these changes. What do you think?
I think there will be a very big issue with that. I mean, in what people will call a socialist country like my own, Denmark, we probably will be better or more ready for that, because there are already a lot of people living off some sort of income from the government, from the state. So we will be more ready for it. We'll just not be, it'll be very expensive for us to do that as a country. But I think there will be other places around the world where this will be, as you said, detrimental, or contra what they stand for, and there will be a problem to say, well, can we actually allow that we just have to pay people for not doing anything? But the problem is, you can look at a situation where you all of a sudden have 20%, unemployment, and people can't pay their bills and can't get food. I mean, then you will have pitchforks in the streets instead. So what are you going to do? Are you going to let people just fall through, or are you going to say, well, we understand that this is something that is needed to be done because otherwise we'll simply not, the society will not stand, and it might be fine that people have a theoretical understanding of that we don't like that, we don't like socialism or whatever, but if it's down to that people cannot pay their bills and they are not relevant to the labor market and there's no need for them because we can get all this produced much faster and cheaper than anybody can do, we have to think like that, and we have to maybe also say that there will be other types of jobs that will have an importance. Maybe we call it in Denmark the warm hands. So this about taking care of other people's, because there's one thing AI can do is really take care of people in a right way. But is that a job that creates a lot of value, or a lot of probably not. But it's something that will be better for humanity if we can take better care of our young people and our elderly people and so on. But again, the whole setup of that, I mean, I'm probably not creative enough to understand that, what will be down the road, but I see your point, and I'm completely with you. There will be some theoretical discussions on whether this is the right thing to do, but I think that by the end of it, it's really down to people being able to live.
Yeah, I mean, I can hear your deep breaths. It's really going to be a profound change, and it requires a profound shift in thinking as well. And I'm not seeing the same urgency to the matter, because we are right on the precipice of significant social and economic change in a very structural, profound way, and I'm really bothered by it, to be honest, because for a lot of I got lucky with my business, and I think I'll be all right, but for the vast majority of people who rely on their labor to make a living and raise families and take care of their loved ones, I can see within 5 years a significant chunk of the economy being performed with far fewer people, and I don't really see any kind of high employment industries emerging, not even like as a concept right now. They're just not there. Every discussion is about how we're going to be able to do more with less, from trucking to accounting to legal advisory, from anything from blue collar to the highest value white collar jobs that everybody would have thought would be immune to technological advance. I'm seeing actually really plausible solutions where I can think, instead of 10 highly paid lawyers, why not 2?
Right.
And we're like, if I'm making an appointment to see a very expensive accountant or lawyer, I can legitimately do an hour or 2 of research and cover 95% of what they're going to tell me for, many, many hundreds, if not thousands per hour.
Yeah.
And, that's going to have an effect on the economy, and then downstream to the education system, all the way to graduates, to the point where people are going to have to, not really have much of a choice. There's not going to be a viable career path that someone can look and say, in 5 years' time, if I pursue this path, I can have, a fair degree of confidence that there's going to be a feasible way for me to be employed.
Completely agree with you. I see the same, and it's just rarely I get to talk about these very long-term perspectives on things here. But I completely agree. In mergers and acquisitions with lawyers, I mean, normally you would have a whole army of young graduates, or whatever you call them, in the legal paralegals or whatever they called, but you can just put the AI to do that in a not too distant future, right? So it'll be just the very top of it. So you will see, as you said, a lot of white collar and blue collar works will be redundant, and that's the thing. But that hits right on the head of the nail there, because it's the situation that we as a society, as an economy, as the global society, we will see, and we have seen before also when electricity was introduced back in late 1800 into the 1900, you would also see that there were a lot of shifts there as well. And we managed to move on to something else. And we don't need so many people shoeing horses any longer, or, these things. So we will have to change. And that is probably the one thing we have as humans find the most difficult, especially as we get up a little older. So there will be a whole generation here of people think, where this is just going to be too big of a change, but it will also open up a massive amount of possibilities. And hopefully, what I hope is that we're going to see this in a positive manner. We're going to see that this will create more wealth to society, which will then make sure we can take care of people. And I'm not a socialist, I can promise you I'm not. But we probably will have to avoid any kind of revolutionary condition or situations. And then you will see that taking more care of people will become something that can become a thing that maybe, we don't need to leave as we do here in Denmark. I mean, elderly people are being left on nursery homes, and you don't have enough people or staff to take care of them. If we become a more wealthy society, probably we can also have more people taking care of elderly people and young people and so on. So I prefer to see it in a positive light, that just because we find it difficult today to see how will people make ends meet and how we earn money, I think we will be, find our way as a human race and kind to understand that we need to change, and there will be other ways of doing business, and earning money today is definitely not the same as it was in 100 years ago, and it will not be the same in 100 years. It will be completely different how we earn money and how we are prospering.
I get the feeling, and I may be wrong, but right now I don't have an insight that proves it to be wrong, or a contrary opinion that proves me to be wrong at this point. But my sense is that this AI combined with robotics is a technological advance unlike anything we've seen before. And by that I mean for two reasons. Previously, when there's been a technological breakthrough, it's meant that human beings were moving up the value scale or value chain, either through physical labor or intellectually. And here we've got the merging of the physical manifestation of labor in robotics and the intellectual capacity, the infinite intellectual capacity of AI, with the potential to merge those two together. And that leaves human beings with nowhere to move up the scale of productivity. And that's why I just think there's almost, from a philosophical point of view, not a practical point of view. Obviously, they're not capable of doing everything right now. But philosophically, just as a theory, there is almost nothing robotics paired with AI could not do much better than a human, except for the one thing that you did raise before, which is care for one another, or that adding a human touch to some kind of service.
Exactly.
And I wanted to bring that back up because you mentioned something about value that was really interesting to me. And I presume you meant from an economic point of view. Obviously, there's value in human relations. Is that, do we start thinking about policy in an economic policy in a different way, rather than measured through GDP and activity and I don't know what these measures will be, to what kind of society we want, a structure of society. And I know, people can talk about happiness and whatever, but there are other metrics that we can look at that we could deem collectively, or we can build a consensus around as being indicative of a healthy society. One of those could be family, for example. And some people may find some of these things disagreeable, but perhaps fertility rates might be another thing. You might be able to measure general sentiment, those things. But how do we bring those to the forefront? First of all, do you think that they are viable considerations for economic policy? And how do we bring those? How do we inject those into our policy making?
I think first of all, I'm not sure it will be. I completely agree with you, and I think that there needs to be a better perspective on what real wealth is. I mean, the moment when we can create all the We can produce as much as we want. We can solve a lot of the problems that we have on the table today. And, we're much faster. We don't need the same kind of human input like that. We need to sit down, figure out from a philosophical perspective and from economical perspective, how can we actually set up our societies so we can do this, so we will have a better future, and then leave all the theoretical discussions about socialists and capitalists and all aside, and then say, this is not about that. This is about that we need to go by as a human race, and we need to make sure that our societies work. We cannot let people just, die. We need to make sure that we actually also do something which will make us prosper in another dimension than what we normally traditionally have been looking at. So yes, that is also why I think we more and more look into what is the happiness of the different societies or different countries in the world, and the security and so on and so forth. And I think that will require a human touch to things, and we will go down that, because it's not about, we'll have endless resources. If we can also, when AIs figure out, fusion for us, cold fusion for us, then, electricity is there, and we'll not pollute the globe anymore. We will have, endless amount of capacity to figure out what to do, how to do things through our quantum computers as well. So I could easily see a world where we need to have this philosophical discussion and understanding on what to do. Will that just be solved by putting up some new measures? I'm not sure that is going to help. I think it'll be down to the politicians of every nation and say, this is now the new reality. This is the biggest shift. As I'm probably with you, I would say that the shift from the steam engine was quite big back in the days, and electricity was quite big, and the computers were quite big. But this is probably where we make one of those quantum leaps that, just simply can't be. We have to look at, if we stood and looked from afar and said, this is where the humankind really made one of the big ones. And I think you're right on that. But that also requires simply a new look on it from everybody's. What is wealth? How is it that we treat each other? How can we, is it really about having 1, 2, 3, or 4 Lamborghinis? And is that really how we want to also drive it going forward? Will that be easy? No, because there will be a lot of resistance to something like that. But I think the countries that will find this model will probably prosper, because deep down there will be the need for security and stable societies. And if it's all about pitchforks in the streets and somebody resisting the change, then it's that's not a society you want to live in either. So I am fascinated. I would love to live another 100, 200 years to see how all this plays out, but fascinated to see what comes along. And there is a good discussion to be had there, and something we need to find, and that's not going to be easy. And I think it probably also can trigger some tensions between countries in the European Union, also where I live, where there will be different understanding of that, and also between the US and Europe in general. I think so. These are. I don't have the answer for that, but it's. I think you're right on. It's right on.
I'm really focused on, these are problems that live in my head, and I don't have the answer, and I don't know how to bring these concerns and embed them in policy making such that, we actually address them, because I just see so many impediments. Part of me thinks that they won't be resolved, and we're actually building this sort of digital surveillance panopticon to make sure that people can't they can't fight the system, and the system will try to bury us before we can reform it. I see signs of that happening anyway. I didn't invite you here to depress you, Henrik. I promise you.
I think it's an interesting discussion, and as I said, I don't normally get to talk this kind of these kind of perspectives on things. It's more like what is the next candle going to be? Like, it's green or red, right? And
we'll get to that.
We'll get to that. But I love it, because I think this is really what we are. This is the big wheel turning. We're talking about the fourth turning. We're talking about we see all the situations around the world with the geopolitically and economically and so on. And if we get one of the big crashes here that I think we can, what is it really how is it that we rebuild everything from? And that is probably where the fourth turning gives us a new world to be built, and hopefully some kind of these perspectives will need to be taken into it, because I agree with you. We need to expand and broaden our view on what is real wealth.
So I'm looking, as an entrepreneur, I look at these technological advances with a great deal of excitement as well. It's not just doom and gloom, because there are so many possibilities that have opened up for me to be able to experiment and try out to see if something can work at much less cost with almost no development skills. Now I could almost build a fully functioning app and test that in the market, which is hugely exciting for me. But also it means that, I don't need those 5 or 10 developers to actually build something out. So from an excitement point of view, I think AI and robotics are going to drive massive increases in margin in the short term, and a potential collapse in demand, consumer demand, in the medium to long term thereafter. But I think economically, we're going to be incredibly excited about being able to do things with less waste, less resources, less everything. I think that's going to be a very exciting period for the world and for the economy. Do you have any views on whether, does that form part of your thesis about the crack-up boom, or is that purely a monetary and markets phenomenon?
No, I think, the normal way I look at this is when we've seen all these technology advances over the years, over the centuries, you've always seen that this has been followed by some kind of technology leap fog. So a diffusion and misunderstanding of what is it really that happened here. So when the computer came out, everybody, there were people saying, "Oh, probably we'll have a need of 5 of these, on a global basis." That was probably not correct. And you saw also with the internet at the beginning also, and we saw with the steam engine when the locomotive came out, they thought it was mainly going to be for business and so on. I mean, it's always this, that there is a technology leap, and we try to make it fit and understand it, and then the confusion starts to arise, and then the money starts to flow into it, because everybody wants to front run this and now say I can become a very wealthy and just jumping onto this train in as one of the first people there, and then the misunderstanding on what the direction of the technology is going to take us. So I think you're right on these things with the productivity levels and so on and so forth. But I think there's a lot of the things we see right now that is a confusion, and which has led to this massive bubble. First of all, the money printing, and then secondly, I have to say, the whole crypto. I mean, is Ledger and blockchain and all these, are they going to change the world? Yes, 100%, completely, but probably in a different way than most people try to frame it these days. I don't think it's going to be cryptocurrencies. I think that is the fog, that is the confusion that people have, and they try to tie it up with the money printing and try to say, well, this is how this all is, why Bitcoin is rallying and why this particular one is rising. I think we need to see that come through the cleansing process. And there's nothing like a cleansing process, like a good, strong recession, where people are just, some of these, strange businesses are just wiped out, like in 2001 to 2003. And then you have the real ones standing up and saying, okay, we actually solve this particular problem. We actually make it more certain or secure for you to trade with whomever around the world. And we can, whatever the different technologies can do. This is that will be the real cycle. So obviously there will be some of these projects we have right now in AI, in crypto and in AI and so on, that will be the next Google or the next Amazon or whatever. But there will also be the ones that just will go out with the tide when we see the recession. And I am actually looking forward to that in the way, not because I know people lose their jobs and people will be, but to clean up. If we only look at it from a business perspective, it'll be nice to see that cleansing of the system and to understand which are the ones that can be the next big movers here in going forward. Which are the ones that really have an advantage. It has something of a business solution that is going to bring the economy and the world forward. And I think that's what I think is exciting about this. But the rest, I mean, I'll use it more as a psychological experiment to watch people, how they talk about that if you have 1 Bitcoin, then you are okay. And if you have 10 Bitcoins, it's generational wealth and so on and so forth. And just coming up with it and trying to tie it together with money printing. And I think it's, honestly, that's the confusion that will happen into these technology advances. But the real technology beneath is going to create a fantastic change for the world. And I think when it comes to the ledger and blockchain and so on, I think it has to do with trade. I think it has to do with smart contracts. I think it has to do with tokenization, which I think will bring a lot more liquidity into all sorts of things. And these, advances with AI, with super quantum computing and so on, forget about it. The leap in productivity of humankind is standing on the cusp of a massive jump.
You offered an insight there about the link between Bitcoin, its price, and liquidity. Can you elaborate on that?
Well, there's been a lot of charts on X where people have been trying to tie up M2 with the price of Bitcoin, and they just go 2 or 3 years back, and then kind of kept within that. And of course, you always have to analyze everything and understand and go into that. So I do that every time I see something. I try to understand what is it that people are looking at. And if you just took it out a little longer, you could see that doesn't really add up. And it was more people confuse correlation with causality. And that is really the problem with that kind of chart that we have seen. So people try to say, okay, Bitcoin only has 21 million units that will ever be printed, and that's it. And that means that it's a shortage, and then hence it's going to go to the moon. I mean, there's plenty of things in this world that will only be a certain amount of. I mean, right? So it's this about that and then you say, because there is a structure to it. Yeah, but as I understand the technology of it, the Bitcoin structure is not even as strong as in some of the other structures. We have the ledgers so I think the whole foundation or the whole argumentation on this, why Bitcoin should be rising just because the money print, we see the debasement, I think is just strange, weird, stupid to a certain degree.
So you see the breakdown in that correlation as proving it was a spurious assertion to begin with?
Yeah, first of all, if you look to history, again, you can go back to 2001 and you can go back to 2007 also and look at the M2, which people were doing, and then say, how did risk assets perform even though M2 was going up? And you could see that into 2001, 2003, you saw that M2 was rising. The central banks were, trying to stimulate the economy. What did we see? We saw an 85% decline. It was 80% decline in the Nasdaq, which was a risky tech-oriented kind of sector. But people say, but this is different now because it's Bitcoin. If you look to the correlation between Nasdaq and Bitcoin, it's like so crazy. It's like ice being sold in the sun, right? It's just going together. And you see that Bitcoin, every time Nasdaq has been declining, you see Bitcoin actually also having a bigger decline. So I think you're looking at an asset here which has been rising because of the technologies that we now see and that the hype we have around that, and obviously also to a degree where the money debasement or the money printing has brought out the effect that I talked about, where yields have been suppressed, and you see that a lot of investment, and that brings about the whole bubble that we have right now, as I see we have. So I think it's of course there is a certain level to it, but it's not like because they print money, Bitcoin will go up, because you can easily have the situation like you had into the financial crisis where they were printing money, as you and I just talked about earlier, and you saw the Nasdaq and the S&P kept declining, in that time frame. If it was like that, why wouldn't we see that they have been rising? So people say there's a difference between Nasdaq and Bitcoin. I don't think there is. I think Bitcoin is a very, very risk-related asset, which will decline when Nasdaq and the stock market starts to decline, and that's why I don't think the correlation has been there for some time. The causality is incorrect. That is what people, they like to jump to easy conclusions. But the real conclusion is that actually more, you have something that is highly correlated to the stock market. And the stock market is now, because of the money printing, in a very big bubble. And that's why you're going to see also these curious projects which have zero yield per year, actually delivering something which is, tremendous returns. And on top of that, you have the human psychology. And when you bake that all together, you get these fantastic moves. So I think we have and technically it looks like Bitcoin will come to a massive top. And if it drops below, which I think it can, 10,000 easily, I mean, we just dropped from 125,000 to 95,000, below 90,000 even, right?
It's just under 90,000 right now.
Right. If we see that due to nothing, why wouldn't we think if, we saw a strong dollar rise, a recession, a liquidity crunch, Bitcoin actually crashing much below that? I think it's very, very likely. And that's why I think people have been jumping onto the narrative train and keep pumping each other. And the Michael Saylor of the world is talking about faith, or if you trust enough in it. I mean, this is the kind of narrative you will see into all sorts of big bubbles.
You just said that Bitcoin's pulled back from, was it 125, 126 to now just under 90 as we speak. I think it's gone down at more than $1,000 since we started this interview. Mm-hmm. Over nothing. Now, when you say over nothing, do you mean over nothing major in a macro sense, or nothing at all in Bitcoin to be able to explain that?
I mean, if something drops by, what is it? 35%. Mm-hmm. Due to what? Because we didn't see liquidity in the system because of the U.S. shutdown, potentially because of that, and we don't even see it in equities. I mean, what would it?
Equities have pulled back though, but much less,
4 or 5%,
right?
In that same front, yeah. So it's like really nothing. And actually, if that is only recently, if you look to it when Bitcoin started out, it's a decline. It's much more. It actually, I'm not even sure that the equities have been declining that much. But anyway, let's say. It's just that why would we think that when we hit one of the largest potentially crises we could see, where we have a deflationary development, where the stock price could start to sharply decline, and dollar, as I see it, will rise. That's not mainstream. I know that. I think the dollar is going to rise a lot into 26. Why would we think Bitcoin will all of a sudden just rise like, the best thing in the world, and we'll just see that it's just rallying. Bitcoin is a liquidity dependent tool, and yes, but it will also be dependent on whether there will be people buying it. And what we see is that if only a few of the big ones goes in and start to cash out or sell their Bitcoins, you'll see that Bitcoin can take a tumble and it pulls down the rest of the crypto market with it. So I just don't see the stability in it. And if something can drop which I claim it will, I claim it will drop more than 95% into the next crisis. And if it does that, what is it really that we are talking about? We are talking about something that is extremely volatile, that everybody thinks is going to be the savior of the world, the financial world, but has these extreme drawdowns. Again, I need to be proven right, but it's 90% is something we have seen. It dropped more than 73%, 75% over 4 times, right? So we're 90% into one of the worst crises when we have a real recession, which Bitcoin has never seen a real recession. If that happens, then, you don't need to be that kind of creative in your mind to think that Bitcoin can drop quite a lot. And that's the problem.
That's a lot to break down. I'm going to hopefully try to remember all my questions because it was a very rich statement and quite a lot to unpick there. Mm-hmm. So you're talking about a potential 90% drawdown from a top of what? How high?
Yeah, that's it. I don't think we're at the top just yet. And I think we're going to see that we see the 150,000 in Bitcoin over the next few months here. I think it's going to go more or less straight up.
Oh, you think that's still on the cards, that we're going, yeah. This is just a pit stop on the way towards 150 plus?
I have a 30% chance that it stops at a lower high, and I have a 70% situational probability on that we see it actually rising very, very strong to 150,000 within within a month or two. I think we normally see into, it seems like a lot, but it's not. If you look into the situation of in 2017, if you look into 21 into the top there, Bitcoin actually twice into the top of 2021 rose by more than 100% in 4 weeks. 100% in 4 weeks, 120%, and then it dropped a little, and then it rallied another 105% in 4 weeks in 21. And in 2017, it rose by 115% in 3 weeks. So people telling me you cannot see 60%, 70, 80%, let's say that's 83% in 4 weeks, I say you can. And you probably will, because I'm expecting it to be a very large top. So I think you're going to see this rally just being extreme. And also because I think you're seeing the equities indices around the world starting to put in large tops. Look at Nikkei, doesn't look good. Look at the DAX, doesn't look good. Hang Seng, so on and so forth. They all are coming to something that, to me at least, looks like very large tops. And if that's the case, you may have 3, 4, 5, 6 weeks more of the fun in the S&P and the Nasdaq, which, by the way, I see the S&P go to around 7,800. Will we then how fast can we then see Bitcoin rising? And with TDA now coming out and the liquidity starting to flow again, I think that is the driver of this next move up, because the economy itself is slowing. There are so many indications of that. If you don't see it right now, I mean, seriously, then macro is not your thing. I mean, you can look at everything from large truck sales. You can look at the ADP numbers. You can look at the duration of long-term unemployment. You can look to everything. Excuse me. So there are so many indications that the economy is slowing right here. And that's why I'm saying we're probably in that final dance now. It's getting close to 12 o'clock, and there is one more dance. And I think that is going to be the one that brings everybody now that is so bearish. And we are now here on the November 19th, so bearish, onto the other side of the fence. And then when I start to say, okay, I think this is the top, then everybody will be calling me crazy, because everybody can see that's been going up with 100 or 80% in 4 weeks. So how could it top here? That is just the normal sentiment. And I was bullish in April, and I was calling everybody out on Twitter saying, this is not the top. I was calling it out in 22 and in 23 especially in 22. So I've been bullish since 22 continuously, and I've called all these declines, but this is different. We're now seeing the business cycle that I've developed is topping out, and the leading indicators are just, plunging, and we are now to see the coincidence. And there's funny thing here, that the U.S. administration don't want to show the unemployment numbers for October, as I've heard, and we kind of see that they're a little sluggish on getting them out. My model was predicting before, when Powell was saying the economy is strong at the beginning of this year, and I was just looking, my leading indicators start to decline, and when we see a crossover of a certain equilibrium, it's normally giving us a year and a half maximum. And I thought, okay, we need to start seeing it in the economy. And you saw the job numbers were 144,000, 240,000 I think it was in April, May. And I was like, what is this? And then came August, and you saw the big revisions. And all of a sudden we had negative numbers in those months, right? Going from something that is an economy that is just thriving and accelerating to something that is a standstill. Now, my model has been declining for such a long time that we should see more declines in these coincident indicators, which are the one that goes with the economy. So I think you're going to see that the numbers are really bad. And I think the reason they don't want to show the October numbers is one simple reason, and that's because they're bad. And if that's the case, then you are not in an economy that is recovering. Then you can have the difference between what I call the liquiditists, which are normally bankers, who think that that's a great thing, because when you start to see the liquidity cycle go up, because that's when the Fed comes in and saves the world. The problem is, if you go back and check that, they have never done that. They have never, ever done that. They've always missed the boat or the whatever. So you're going to see this uptick in liquidity. And immediately now, when we see it potentially here and the Fed comes out and say, hey, we're going to cut in December, I think you're going to see that move strongly higher as well, also driven by that. But unfortunately, I think it's going to be the last one, because that's the moment the real economy starts to take over. And 62% of the Americans right now live paycheck to paycheck. 15%, 16% have very hard to put enough food on the table. This is based on the very new analysis or surveys. So we are not in a situation where the economy is great. We see the consumer confidence is just plunging, and people can't, the affordability is down in the gutter, as we talked about earlier. Why would we see a pickup of the economy here? I don't think we are. I think we are heading into one of the worst recessions we have seen since the 1930s.
You think the impetus for Bitcoin to bounce up from where it is right now and the markets in general, would be the Fed signaling in late November, early December?
One of the things. There's never just one thing. But I think, first of all, the structures that I look at are simply not done. That's one thing. People don't understand that. But there is something about structure psychology. So this is the psychology where we bring people onto the wrong side of the fence, and then you see the final surge where everybody will be in. Simply, too many people have caught the right top this time, if this is the case. That is one of the things. That's a psychological perspective, argument, indication. But I think the TGA that comes out now, all the money, the taxes and so on that has been, standing idle at the Treasury right now will now start to flow back into the system. My leading indicators have been showing that we have a deterioration which started already in last year, in 24, and normally that gives us a year and a half in terms of warning before we start to see the rollover of the coincident, which is the real economy. That was why I didn't understand the strong numbers in early of this year from the non-farm payrolls, which are surveys, and Powell was so secure and say on the strong job numbers, talking about this strong labor market, and his colleagues around the world were actually surprised to see how strong the economy of the U.S. Economy was. So that was just weird to me to see that in March and April and so on, we had these numbers at 144, 240 something, which is a very strong economy. And then all of a sudden we had August, and we saw these big job revisions, which is actually bringing the way the Fed at least should look at the economy closer to what I think is the reality of the economy, which is that you have a slowing economy. So, and you can then say, my model is predicting that we have a further slowdown and it's going to end in a recession, because it's never been wrong. Every time you have a leading crossover of what I call the equilibrium line, then you will have a recession at some point. Going back to 1950s, not too many signals, not too few. Meaning we are in the final phase of a economy boom, which now potentially is going to roll over. We are already seeing a lot of signs on that around the world in various indices. And I think you're going to see that the economy in the US will come to the same. Does it mean that we cannot have this, strong rally that I'm suggesting? I think it actually is pointing out that we're going to get it, because that is the final, gasp of the economy and of the market when they hear that the Fed is going to support the economy, is maybe being a little less hawkish, but we don't even need that, because right now we have all the taxes and everything that's been standing still as the economy has been shut down is now starting to recirculate, and you have it like $1 trillion standing, which now will be over the next 4 weeks is going to be re-enter the economy, and I think that is going to be the final surge of things, and that's why I think there is a good basis for saying that I think Bitcoin can rally from the current levels to the 150,000. As I said, it's 70% potentially that we could see that kind of 75, maybe even seeing that kind of move, and a little less 25 that we only see up to around 120 again before we see another decline. I just can't make it up like that, because if we look at the thing like the DAX, the Dow Jones was what I was trying to say, and we saw that has actually been putting in a new high last week. It would be strange to see that the Dow Jones should be outperforming both the Nasdaq and so on, and also Bitcoin. That's not the way that the sequencing of things work. So I think we're seeing the final decline now, this final correction before we have a final push higher. It's a wave 5 for all Elliott wave lovers. And that is going to bring everybody into the market and saying, oh, we now all forgotten about what we talked about on November 19th, because everything is now fine. The Fed is there and the economy is strong, and AI, because that's the narrative. And then you'll see that the market tops out, because the real economy, Mrs. Johnson, Mrs. Jensen, whatever they're called, are suffering. And we can see that. And that is the real deal of the economy. And the problem is you have a lot of people thinking liquidity would drive things. It may seem like that for a short time, but come the real economy starts to roll over and you see unemployment moving up, you're going to have a market crash.
You think the gravity of the contracting economy will pull markets down eventually, or do you think it will happen step by step, hand in hand with the actual economy contracting?
I think you will see that that also due to the private credit situation we have, that there will be some kind of, we'll call it a black swan. It's not a black swan because we can almost expect it to happen. You have a lot of consumers that are really feeling bad, and you can see credit card delinquencies going up and so on. And we expect that nothing will happen from that. And the Fed is actually almost dismissing that when he was asked 6 months ago, what about the consumers that are not feeling so great? And he's like, yeah, it's something tariffs he's talking about. ridiculous. It's not about that. It's because they can't afford to sit in their homes, and they will try to make ends meet. And if you look at the number of people actually also working more jobs, 2-3 jobs, that has been rising as well. So you are in a situation where the real deal of the economy, which is the bottom 70-75% of the population, is struggling. The water is coming in on the Titanic. The third-class passengers are seeing the water coming in and feeling they're getting wet feet. You're seeing the first-class passengers are talking about what kind of gin and tonic or whiskey they should have next, because they just don't see the problem yet. And that is the situation, because the real deal is about the economy. And this is where we have a schism actually right now, where I'm standing for the business cycle, which is the real economy, where you can see it's labor, the participation rate, it's real people getting a job and not getting a job. And then you have people saying the credit cycle will save everything, because when the Fed comes in, everything will be saved. I don't see that. And I think that is the big schism that is going to be. Yeah, at least the judge or the jury will come back in and tell us which one is right when we get 1 or 2 years down the road.
Henrik, I remember in the aftermath of the 2008 financial crisis, there was a research note put out by, I can't remember which investment bank, that effectively said there's going to be a bifurcation in the economy, and if you're looking for stock tips, have a look at basically the low end, the dollar stores, and your high end luxury, basically. And that effectively played out. That's exactly what happened to the economy. We saw a bifurcation where people with money had a lot of money, and you could almost say all the money, and then there was everybody else. And I wonder if we're just going to see a reenactment of that, or if that's just going to continue, because from where I haven't looked at the macro data, but I've felt, just looking at the high street, my high street, which is one of the most prominent ones in London, that we just have not recovered from 2008-9. It has not been the same. I came to London in 2006. There was an incredible buzz on the street, on the high street. People came to my neighborhood to shop, to go out, to have lunch, dinner, breakfast, everything. We've never recovered from that.
Agreed.
Ever. And it's been almost 20 years. And so I'm wondering, like, consumer confidence is low. I'm like, hasn't it been low for 20 years?
It actually hasn't. It hasn't been low for 20 years. And the situation is exactly as you say, to put it. We haven't seen a real recovery since 2008. And if you look to the banks around Europe, you'll actually see that we only talk about a bounce. You had a very big decline, and you'll see that they've been bouncing along. And I think you're going to see the next big decline also coming there. But if you look also to that actually tells a story. If you really look at it like that, it really tells a story that whatever we tried to do in 2008, which seems like the solution, and we gave Bernanke the Nobel Prize for that, which I think was so ridiculous, which is why I mentioned it twice now, that, this money printing just helped. And everybody's convinced that he saved the world back then. He did not. He kicked the can, but he kicked it far enough, and they keep kicking it down the road until a moment where something else breaks. And this is what I think people don't understand, is that he can save us from deflation, but he cannot save us from something that is worse, which can be stagflation and inflation. And that is really the problem. And to this point, to this day, I agree with you. We haven't seen a real recovery in many economies around the world, which is why a lot of indices around the world, actually in Europe, you'll see that they have not reached all-time highs. So there is a division there between what we've seen in the US and some other countries, but also in other around the world, where we simply haven't seen this kind of move. And that has been because of the whole tech boom and everything, but also to a certain degree a level of euphoria into this into the whole money printing thinking, and that can create wealth, and people have just been running along with that. The real economy, the real consumer, things have not been solved. They have higher levels of debt right now, and we're looking at higher levels of inflation now coming down the road, as we potentially could see, and they are struggling with the yields and so on.
For some time now, I've thought, what's transpired in Japan over the last 45 years is kind of a very high level playbook for what is going to happen in Western countries. Do you see the analogy there as something that's valid?
Oh yeah, definitely. I think we have had Japan has been printing money and trying this QE for way longer than we have, and they brought themselves into a situation which is actually what John Maynard Keynes were talking about when he was asked, so what happens, Keynes, in the situation where you've been stimulating the shit out of the world, or the shit out of the economy, and you have, brought interest rates down to a zero, and you cannot stimulate it more with that. What do you do then? And then he said famously, in the long run, we're all dead. He didn't answer that question. And I just have to say, I think we're seeing that moment in Japan right now. We have valuation levels are at perfection. You have seen that now the stock market has also risen quite a lot here, but you've done that through money printing and through lowering yields to the extreme. Money has been flowing into it, the carry trade and so on. But it's a situation where we simply cannot stimulate more through that. And that is the problem with this whole thinking, is that if it does not create real wealth down the road, it will eventually come to haunt you, and you'll see inflation at the perception of wealth is going to be taken away again through inflation.
Honestly, that reply, it just angers me so much because it's such a dismissive thing to say that in the long run we're dead, so don't worry about everything that happens in the interim. And it's like, hang on a minute, have a look at all the harm that you're doing, the disintegration of society, the stagnation of society, people for generations unable to even aspire to what their parents had when, prior generations, prior to the baby boomers, actually each generation aspired for more, for greater. And in fact, parents wanted that for their children. I think that what we're seeing in the baby boomers is the first generation who literally did not give a shit about what they left behind. And as a result, they're actually leaving behind a complete economic and social catastrophe. I don't have too many good things to say about them, except for the music, to be honest.
No, exactly. But I think what you're touching on is actually the very reason I wrote my book, which is called The Everything Bubble and the Bust caused by the central bank hubris. Because what we have seen here is the hubris of central banks thinking that they can actually create wealth. And they have been convinced and been reinforced in that kind of understanding over the years, because every time they've touched something, they just sprinkle. Every time there's been a problem, we sprinkle a little liquidity on it, and everything is fine. And if we told our mom and dad or our grandparents, why did you do that in the 50s and the 60s? Why did you, or the 70s actually, even worse? Every time you had a recession, why did you just throw money at it? I mean, we do that here. It's called QE, monetary, new monetary theory or whatever. It's called modern monetary theory, MMT. And every time we do it, it's not a problem because there's no inflation coming, and we don't have, everything is good. It's just naive to see. As I understand it, it's because you've been living in one type of regime where it has been driven by the deflationary forces that we talked about earlier, and also by high debt levels and so on. It has actually been, reduced. There have been a downward pressure on price levels. And again, then it's back to the psychology of the whole thing. What is driving inflation? How is it driven? But I think the asset inflation that we talked about as well can be also a driver of consumer inflation down the road as well, because there will be there will be a transfer through the also when assets can't go any higher, then you'll start to see that they will try to seek out other places, and then you're going to see that there will be inflation in other kind of assets as well. So this is inflation hasn't been a problem; it's now becoming a problem, and I think that is going to change the regime and the opportunities for the Fed. The Fed is the culprit, not just the Fed, but the central banks of the world, of what we're in right now. So when you say you're angry with somebody here, with the boomers, then I think it's actually with the understanding of how far can you actually take monetary theory. And I think that is what we have been misusing to the degree which is now going to be felt by a lot of ordinary people.
Yeah, when I look at what happened since COVID, I think they're quite self-congratulatory, actually.
Yes.
The Federal Reserve and the Treasury think they handled that beautifully.
Yes.
So I don't think that they see that there are any lessons for them to have learned and to revise any kind of policy framework. So they will continue to try to smooth out cycles with monetary debasement, no?
Yes, they will until somebody says. But that is one of the reasons I actually want to write my book. I want to say this is because of the hubris of the central banks, because they think they've become demigods and become omnipotent, talking about climate change and how obviously they also shove that away. But just to think that they can fine tune the economy down to, we don't want 2.7, we actually want to get closer to 2.0. I mean, it's like, come on, guys, this is a, multi-trillion-dollar economy with psychology that can change like this. And you're looking at lagging indicators based on surveys for some of them, actually, when it comes to the labor market. And you think you're capable of fine-tuning the economy down to that level. It's so naive.
Yeah, they really do believe that. They really do believe that. And they give each other awards and pat each other on the back and everything. It's just like, what are we doing here? It's
incredibly naive. Naive. And what they do is, in the meantime, what they have done is simply they have been sprinkling money on every time there's been a problem. And then all of a sudden, the inflation came up. Now we need to solve that. And the real problem for them right now is that they're actually realizing, I don't think inflation for them is the problem here. I think the problem for them right now is that they realize that there is a bubble in the stock market, and they don't want to fuel that any longer. And they don't want to, be the reason that it's rising, being even bigger. But the problem is the real economy is coming from beneath, and people having problems where they actually, if they look to the real economy and actually cared about the real economy, then people should see that the rates were cut a long time ago, because that is what is showing in the consumer data. So the consumers is one place, and the financial markets are a completely different place. That is the problem we have right now in a nutshell. And the Fed is trying not to fuel the bubble further. They don't want to pump it. But they would like actually to see if they could, support the consumers better. But they just can't, because they are now in a fix. They are in a corner. And unfortunately, we are in that fix with them.
I mentioned earlier that, my idea is that this whole thing has been essentially to pump up asset prices so that boomers can pay for their own retirements. How long until we're done with these people?
How long until we're done with them?
Until they're, as a political block of power, that they're actually subsumed by the subsequent generations.
But first of all, it requires that we realize this as economists, analysts, and so on. I think I'm probably, a lot of people say we'll end the Fed because there could be some reason for that. But I think that kind of view needs to rise up, because we need to realize and understand when this bubble bursts and all this calamity and bad things are going to come out of that. We need to understand why that is happening. But unfortunately, there is a tendency to say, who's the president of these days, and that's going to point to that president and say the U.S. president is the main culprit of that. And when he's been talking about and been introducing these tariffs, that's the reason. Unfortunately, I see that history is not, and the people who write history are not more wise than that, and it will probably not come through. Then I hope it will, that this has been created by a reckless approach to monetary policy, and not just to, is it helping what we see with tariffs? No, it's not. Am I saying it's the one and only thing? No, it's not. But it's the main thing is we have tried to create wealth out of thin air. We're now realizing again that it cannot take place. And we are just going to see a lot of, problems first before we see that we hopefully come to that conclusion. But I fear we don't. I don't think people will come to that conclusion. I fear that the history will be that this was President Trump's fault, that we have a recession because of tariffs. And yes, there was somewhat of a bubble, but it really was down to the policies that changed that made this. And it takes a little more to think through and actually understand that this is actually based on the policies of the Fed, because they are putting us into a situation where valuations simply cannot go any higher. And at some point that will create inflation. And when that comes out, that is the problem. And that's what we see now.
Quite a lot of the economic discourse on, Bitcoin timeline is pretty well aligned with a lot of the things you're saying. But I often wonder, is that anything close to consensus in the economic establishment, or amongst economists in the world, in institutions, or do they all buy into, the central bank policy framework of the Fed?
I don't see many people actually questioning what the Fed has been doing. I mean, again, we gave Bernanke got a Nobel Prize for saving the world and for understanding, and we praise how he understood what needed to be done and what we couldn't do in the Depression. We did something differently there. Actually, we kind of did many of the same things, but there were things that were different this time. Yeah, and he was then now praised for that, and and that's why. And now we have this insane monster in the financial markets, which just seem, and even worse so, they have the understanding that money printing can just say everything, and the Fed will not allow that the markets will drop. I mean, these kinds of crazy talk is what we have created now based on what we've done, and they, the next crisis will be much worse because you have a situation where it will not just be deflation. We're probably also going to handle a situation with inflation and potentially stagflation. And hopefully there'll be a learning from that, but I fear it'll not be the case.
I don't hold out much hope for lessons learned and a change in policy framework. So I guess, we're left to do the best with what we can expect, which is, I guess I'm not really sure. It sounds like, get into some cash at the top.
Yeah, no, sure. No, I think you're right. I think there will be a time where even through an inflation that just is sitting in cash, and especially for people not U.S. residents, it'll actually just to have the dollar. And that's why I'm thinking also I can see the dollar can rise strongly into 26, because you're going to see that a lot of this unfolding of the whole crisis of loans being called in and default and bankruptcies and so on will require real US dollars, because that's where most of the loans around the world is denominated in. So that will require that kind of cash, and that's why I think there will be a fantastic rally in the dollar into 26 when this starts to unfold. So you're right, it will be about cash and even bonds, and people don't like that because they can just what is that actually worth? But I think there will be a short time frame from when the liquidity crisis and the deflationary bust begins till the Fed comes back in. The moment the Fed comes back in again, I think they're going to change the game. And that's why it's going to be I've talked about this on various other shows, and I said, I think it's going to be a whipsaw. I think you're going to see now an extreme rally, people getting all euphoric. Then I think you're going to see that the deflationary bust is going to come, and then people think, it's not good to be in equities, it's not good to be in crypto or anything like that. And all of a sudden, you'll see then the Fed comes in, and then you're going to see that bonds will not be so great. And then so I think it'll be all the worst things to come out and just whipsawing people right in the face there. So I think it'll be a very difficult time the next few years.
Can we compare market crises and I guess in anticipation of what the next one may look like in terms of price crashes? Because the two that remain in my mind, the COVID crash, obviously, and also the 2008 one. Mm-hmm. And I remember the 2008 one, it was almost like every 6 to 12 weeks there was a realization that it was worse than what we'd already realized. And that persisted for about, 9 months or something like that. Yeah. And then we just kept going down there. It was just another leg down in 2 or 3 months and another leg down. And there was no sense that this thing was over because nobody understood how big it was going to be. The crisis, the financial crisis. Right. Whereas COVID struck us and it was a kind of sudden realization within 6 to 8 weeks. The markets were kind of edging and then just fell precipitously. And that brought, a swift government and central bank response to which the markets responded very, very quickly. Whereas in 2008-9, it was a much more gradual recovery. What kind of shape could we expect the market response to be, this time around?
I think the difference between the two was that actually the virus or the pandemic helped us. Why do I say that? Because according to my economic indicators, we actually already had a slowdown in the economy going on since 2018. And it was very visible also in the short-term yields. You're seeing them dropping quite fast. And my leading indicators were signaling already in 2019, late 19, that we are going to see a recession. So it actually captured that. That is one thing. But what happened then was all of a sudden we had it just broke out. And the Fed actually stepped in at an earlier phase, you can say, in the crisis unfolding than they would have done if you had not had the pandemic. So you actually saw them stepping in, let's say 5, 6, 7 turns earlier than they normally would do, because they all of a sudden it just fell apart like that, and they had to act. Mm-hmm. If they had not, I think this could have developed into the recession that we then could have seen at that point, which then would have been more like a ordinary recession, or also with some kind of a big crack in the stock market. But because they stepped in with as massively as they did, and they introduced this kind of crazy stimulus and demand stimulating the economy into a supply crisis, we actually saw inflation. And the size of it is so great. I mean, I'm not sure people really understand how big it was. I mean, we talk about the Marshall Aid to Europe after the Second World War. This was in, equal money, so not deflated money, but in equal money, larger response than it was to rebuild Europe. I mean, that was just what came into what we did, what Germany and everybody else did. It was extreme. So when you do that, obviously you're going to create a spike, and you're going to create at least a massive spike also in the financial markets. Everything we've seen since 2020 has been because of that extreme spike in the. Is that real value? I don't think it is, and that's not all economies that have seen it. So back to my story, that was where they stepped in earlier than they normally would. In 2008, they stepped in too late, and they stepped in actually, and they were too hesitant also when things started to unfold. Today, they are stepping in too late, and they are too hesitant. So I think we are seeing something more along the lines of the 2008, not just because of the Fed, but because of the dimension that are very important here. Is that, first of all, you have a bubble, a tech bubble this time around, which is larger than we saw in 2001, which you actually did not have in 2007. But you also have a market, a real estate market that is in the gutter and doesn't, move, and which means that you actually have 2007 plus a 2001 on steroids, and then we combine that. And you're on top of that, you have a private credit market, which is our shadow banking system that is all leveraged up, and we don't know how big it is. So if you take all of that now, and the Fed reacting too late to a situation where the economy is rolling over, that is the problem. That is where you're going to see that it's going to be bad, because it's going to be a balance sheet recession, just like 2008. The difference you could look between is the difference between 2008 and 2001. 2001 was a mild recession because we actually only saw it was a pop of a bubble, but there was not really, any problems in the housing market. That we saw in 2008, and we saw it in 1991 as well. Every time you have that becomes bigger bubbles. Bigger declines. So this time, the largest bubble we have ever seen in the stock market by all valuations almost, and you have a housing market situation, and you have completely a consumer that is so much in the so depressed that it'll be very hard. We have to understand again the psychological element to it, that if you start to help them, that they actually dare to take that help and start spending the money. If they don't, because they are so depressed, it's going to take longer. So that's why I think, and then you have also the next thing, which is you have a new inflationary regime. You have that when inflation is going up, and you're seeing that is actually putting in what I think is going to be a new secular bull market in that. Having all these things together, it's the perfect storm.
So you agree with Trump that the Fed has been late to cut rates?
Oh, yeah. Horribly late.
That's not just Trump,
No.
Talking big.
They have their tools. They are hopeless, outdated tools. I just want to say, looking at inflation, you can just take a chart with inflation on, and then put in the recessions. What you'll see is inflation often goes up higher into the recession, and then it starts to decline as the recession sets off. Now think what the Fed is doing, and you can understand why. Because when you have inflation is something that comes through the supply chain of things. So you have raw materials, you have some intermediate products, and so on and so forth. Before they hit into the CPI numbers, they've been going through quite a significant timeline there. And then before you then start to measure it and you get those out, which takes another month or two, you're looking at something that is 3, 4, 5 months back. Now, this is what the Fed is using as their guidance tool to guide the economy going forward. It's mania. It's crazy. You can just look at it, put these recessions up, look at the inflation, and then say we're looking at inflation. But guess what? If the economy rolls over and the consumers are not feeling great, the business cycle or the growth is starting to go into negative. Inflation is not a problem. So that you sit and wait for the inflation to drop is actually like, waiting for the car to run over the cliff and then say, okay, we need to brake now because otherwise we'll run over the cliff. That's what they're doing. So they need to have updated their tools. It's completely nonsense to sit and look at something which is actually looking out the rear window.
They're not stupid people, right? But why do they make these fundamental errors that any time I speak to anyone whose job it is to analyze the macro landscape, almost everybody says the same things that you're saying. When I'm within a certain circle, right? They're all like, yeah, the Fed is often late, almost always late. Their tools are outdated. It's almost like they are engineering a catastrophe to make themselves useful. But I would ask, I guess the question is, who takes advantage of every crisis?
Yeah, you could say that.
You know what I mean? It's like, what are the incentives here because then if we can agree that they're not stupid people.
No, but I think it's not about stupidity.
But they make the same errors every single time. They're always late.
I don't think it's about stupidity. Yeah. I think it's about somebody daring to stand up. I love the tale of the fairy tale of the Emperor's New Clothes, and really everybody's praising them. They do a fantastic job because they save the economy. They have this fantastic tool. They can just print money. And who dares to stand up and talk about the elite like this? I mean, I think you can look at charts and say, why did you do this? Why did you do that? Why don't you? I would love to see what they are looking at actually in the Fed and say, what kind of consumer data are you looking at? Right? What with the consumer, you can look every time. You can take another chart and look at the consumer sentiment. Every time it plummets, you have the unemployment rate. You can just invert the scale and you'll see unemployment rate follows the consumers 1 year after, let's say 2 years after maximum. Why don't we look at that and say, shouldn't we be looking at what the consumer is feeling? And when the Fed was asked about that, as Powell was in 6 months ago, he had no clue what to say. So I don't think it's about stupid. I think it's about, this is how we do it. We are actually being praised for it. Why would you change a winning game? And by the way, every time we have a recession, we can call it up. We can, put it on tariffs, on whoever was in charge, George W. Bush, or on the president's side, which it doesn't have anything to do with. But it's really because it's nobody's asking that question. That I think it's who comes up and say we need to reform the system needs to be somebody who actually understands this in detail and says this needs to be updated, because why do you look at inflation when we can look at a simple chart and say over and over inflation is rolling over the moment the recession comes, and you are late every time. In 2008, inflation was soaring at 5.5% into mid-2008. Was inflation the problem by end of 2008? The answer is no. They were talking about deflation, and they were running in, with the easy money printing, QE, because it was deflation they were afraid of. So why on earth are we looking at something that did not forecast 2008 session? It did not forecast in 2001 as well, and it has not forecasted any. But if you look at the indicators that actually do that, at least I don't see them that they follow that. That would be it. So it actually in their mandate, that is the problem. They have to reflect on and say, we look to inflation. Inflation is a little too high. We have the thinking, or we believe ourselves that we are able to micromanage this from 2.7 down to 2.2 or 2.0, and we do that through these very, rough kind of mechanisms, and where there is a lag to anyway. Also, I mean, just think about it. You lower rates. I don't know how you feel, but I don't feel like start spending money because the Fed is lower rate the other day. I mean, there is a lag to things. So it is a naive system, and nobody questions it really to the degree, because we just have to sit and look at the charts. And if that is done, who would then say it needs to be reformed? Is that the 200 PhD student people that they have at the Fed? No, because that's what they do on a daily basis. They believe in what they do. Is that the Fed chairman? No, because that's not what he needs to do. It is somebody standing outside with enough power, pointing to them and say, guys, you're not doing a great job. You're doing an awful job. And you've actually been the reason why we've had these massive recession and these massive bubble popping. But who does that? Who can do that?
I get the sense that they're quite happy to sort of see a crisis emerge, and they can just sort of write that off as a force of nature. The economy,
Right.
The economy is doing it, and then they come in, swoop in with their policy measures, and
Correct.
sort of save the day and make themselves feel useful. And in the
Yes.
process, I guess who's benefiting from that? When those policy measures are enacted, it's basically all the insiders who get access to cheap money at low prices when assets are suppressed. So it's
Wall
almost
Street.
like there's a built-in system of incentives to just let almost, I don't want to say manufacture, but at least don't prevent a crisis.
I just think that they are more, you think that they do it on purpose. I think they are more stupid. So I think that's where we stand. I don't honestly, I think actually they want to do a good job if they could. But maybe I'm naive. It could be that it's, I always think the best of people, but I think they are naive, honestly.
I was positing that perhaps they think they are doing a good job and what they're doing is the job that they should be doing.
Yeah, that would be the conspiracy
Cynical?
kind of, and a cynical kind of way of looking at it. But I honestly think when you look at it, especially PhD people, that they'll probably like to, do a good job on what they do and not just be feeding the financial world. I just seem to think that it's because the financial world just stands right there, ready for take it off and just pointing to anybody else and say, oh, by the way, nobody could see this crisis coming. Nobody could see that. Actually, when everything is flashing, then that's an easier way of, it's easier take of things. So I think honestly, I don't think they understand how to do it, and I know that's maybe a little arrogant to say when you have 200 PhD people or whatever they are hired there. But I just wanted to say, who could actually challenge them and who would actually go and challenge their own job? Within that organization, 200 people, how many they are that sit and do their analysis, raise their hand and says, have we ever thought about how we can reform how we do things? Because obviously it seems like we haven't actually gotten things right. And actually this year in 25, we thought the economy was strong back in earlier this year. And I hear now, I've been here 3 years and I've seen we've done the same thing all the time. Why didn't we look to some other things that were actually telling us that the economy was not that strong as we thought in January, February, and March? Who would do that? Who wants a promotion?
I guess you're right. And I think the incentives are set in place at a very high level and high structured level. It's kind of, I had a conversation with someone who was working in government on policy, and I said, the City of London is designed to do what it does. He goes, and what does it do? I said, it launders global capital. It's a money laundering center of the world. And he just looked at me aghast as if it was the first time he's ever heard of such a thing. And of course, that's what the City of London has done well. We could say for centuries, but at least for 40, 50 years. So I guess, when you're working in the detail, perhaps you are oblivious to what is actually happening and what your purpose is. Because what you're looking for is what you're working towards is your next promotion.
Just think about it. And I don't know if I can bring it up here, but
you can.
At least I have a model which could potentially foresee any recession that could be coming, coming, right? So here is what I call my business cycle model. And the business cycle model is based on a leading indicators index, a coincident indicators index, and a lagging indicators index. Really just this one thing. What leads what? What is the sequencing of things? So if we look at this now and we say, we have the leading indicators, which is the red line. Just focus on the red line, forget about the blue line for now. And every time the economy is going through the equilibrium line here, that is a recession signal saying, okay, now things are deteriorating enough to send, a negative feedback loop to the economy, and we will then see a recession coming, which we will not see at the moment when it rolls over, but which we see the moment we see the coincident levels, indicators roll over, which is employment, manufacturing level, and so on and so forth. And what we've seen into the 1950s is that every time this rolls over, every time, meaning crossing through here, you're going to wait for it, and you're going to see a crossover of the coincident, which means that you have a recession.
We're almost there. Is that right? Yeah.
Yeah. So what you have here is now that this one crossed over now in November 24, which is what I said. That is when I see the economy starting to deteriorate. It actually also, as I said, crossed over in August of 2019. Capturing the recession also in the COVID situation. It crossed over in November 2006. See, you don't call the recession here. What you do is that you say, okay, now Titanic hit the iceberg, which means there's no going back. That means that we have to start looking at the coincident indicators, which is what I do then on a weekly basis, daily basis, and say, when do we start to see the deterioration here? But you have to expect deterioration in employment, manufacturing level, and so on, the moment you see this crossover. See, right now we haven't seen the data from September and October. My model is saying that it should be quite, bad, as we should expect this. And this is what I've said all along, that my model was showing this kind of development now in the leading indicators, which is not telling us something good about what should be coming in the real economy. And now we hear that they don't want to show the numbers for October. And, so we have a model here. At least this is what works for me. And now it'll have to prove itself again, because obviously I wasn't here using that back in 2000 or even 2007 here. I have to say that, but and also not in these days here. But this is based on fundamental data, which can be reproduced. And if this is correct, and you see this crossover here, and you go back to the 1950s, why is the Fed hawkish at a time like now, where the leading indicators are crashing? And this is clearly rolling over, is what I want to know.
What are they saying? How are they justifying their policy action? I mean, they have cut rates, right?
No, but they're talking about inflation. But it's so easy to show that inflation is lagging the business cycle, and that's why inflation and yields and so on are lagging the business cycle. They start to roll over. So when you have a crossover here, then it comes here, and then it comes here. Then it comes, again and again and again. So first leading, then lagging, coincident, and then lagging. And now even the lagging indicators are declining, just like what we saw in into the financial crisis, which means that this is going to be much worse. So we have a situation where at least this model here could give you some kind of indications of, no, the economy is not strengthening. You shouldn't be worried about inflation at this time. And you are in a situation where you should be seeing weakening economic data, which is what we see, which is what all of a sudden, Powell saw that in August after having stated that this was a strong economy. So if this crosses over here, every time it does that, that is the time when the countdown for the real economy. You have to remember when the economy falls into a recession, it has to be recognized by NBER. And back in 2008, they did that in December, 1 year after the recession started. The moment this one crosses over, plus when I see a few of what I call my imminent recession indicators starting to roll over as well, then I will call the recession, and you could probably do it within a month of the beginning of it, maybe even under a month. So I don't know why they don't look at leading indicators. I mean, they are there. It's fundamental data.
They would surely have internal leading indicators. Perhaps they don't share them though, right?
They will, but there's also this that is called analysis paralysis. There is something where you take in so much data that you don't understand what is up and what is down. And I think that is what it is. You have 200 PhD guys sitting there looking at all sorts of things, thinking they are so clever, and they are actually making it too complex. So try and make it more simple, and then say, well, if this is what we have seen since 1950s and it's now showing the same kind of pattern again, maybe we are a bit too hawkish this time, right now. And they are, and they've been that for a long time.
To wrap this up, we're all Bitcoiners, so we want to know price by the end of the year and price at the top.
Price by the end of the year.
We're about 6 weeks away now from New Year's Eve.
I'll say you have reached 150 before that, and you have seen a small decline into 135 around New Year's Eve. So I'll say 135 for New Year's Eve. And then you're going to see somewhat of a bounce into the early part of January. So I think, which will bring us back up to 140 something. So I think you're going to see, let's say 135 by year end, and 150 has been the top at that point.
Henrik Zeberg, thank you so much. It's been a pleasure talking to you.
Thank you very much for having me on.
Can you tell people where to find you, website, Twitter handle?
Yeah, At Henrik Zeberg is Twitter, and also on Substack, I also have a few groups there. And at Swissblock, where I am the head macroeconomist, we have our institutional clients that I'm helping to understand the ups and downs in the economy, and I do that through some publications we do, and also a weekly video where I simply talk through the business cycle and connect that with the markets and why do you have an extra leg up and down or whatever. And this is what I do. So you can also find me there. But at Henrik Zeberg on X would probably be the easiest way, and write to me and I'll try to write back.
Thank you, Henrik.
Thank you.